welcome to the first Chicory Wealth webinar of 2024. 2024. I remember when that seemed like that was going to be a long time away. You know how that goes. My name is Maggie Kulyk. I am the founder and CEO of Chicory Wealth, and I am delighted to be with you this morning, along with our tax manager extraordinaire, Jeff Audi. Raise your hand, Jeff.
Hey,
Jeff.
Maggie. Hello,
There's Jeff.
everyone.
So Jeff's joining me today. We are recording the video. You can have your camera on if you choose, that's fine. But if you do have questions, please put them in the chat. That way your face will not be showing when you speak, which we can't edit out. So, but we're happy to take any questions you have about any of the material that Jeff is presenting or anything you might want to ask me about. I'm going to go ahead and jump straight into today's topic, which is how to prepare to make your tax season less stressful and easier for yourselves and for us. Also, let's face it, there's that piece too. And then if we have time at the end, I may ramble on a little about the markets, but I want to jump right into the tax program today and talk about that. So I think I'll just start right in and turn it over to Jeff. And is anybody hearing any barking in the background? Okay, well then I'll be muting while Jeff is speaking. And I'll be muting now. Jeff, take it away. Thank you.
All right, Maggie. Well, I might have some barking in the background too, but we'll keep our fingers crossed that it stays to a minimum. It's so great to see everyone this morning. I see a lot of clients that I work with, which is wonderful. And yes, tax season 2024 is among us. The link to the tax prep portal, the secure portal, went out yesterday afternoon. So if you are a tax client, you should have received that. If you haven't received it, or if you have any difficulty accessing the portal, shoot me an email, let me know. I'm more than happy to help. But yes, so from the basics, Maggie, the link to the tax portal went out. That allows clients to do three things: electronically sign their engagement letter, answer a very brief tax questionnaire. It's about 20 questions, and then upload their 2023 tax documents. It's also about 23 upload spaces, and you can mark them as do not apply if they don't apply to you. But what we ask when clients do this is spend time doing it and be very thorough. The questionnaire piece, the second piece, Maggie, is just so important. We ask really pointed questions. Did you purchase an electric vehicle during the year? Did you purchase any home efficient, energy efficient property during the year? These questions are meant to help you. We don't want to miss any credits that you might be eligible for. And in the document checklist section, definitely go through all of the different inputs. And at the very end, there's even a spot for, if there's something that you want to upload that there wasn't a designated spot for, it's not a 1099, it's not a W-2, you can upload it here. So it's kind of like a catch-all at the end. So we try to make it very simple and very organized for our clients. Two other things that I want to mention real quick, Maggie, before we move on from this. If you filed jointly, you and your spouse probably got a link to the tax portal. You can each upload your documents separately in your own portals, and we'll combine it on our end. Or you can just use one of the spouse's tax portals, and that works fine as well. And the second thing is if we prepare multiple returns for certain clients, so maybe clients have an individual return and a trust return, you use the same login credentials for both. You only have to enter your tax portal, and you can toggle between the two returns. So we make it super simple if there's multiple returns that need to be prepared. Any questions on that? Definitely shoot them in the chat. otherwise, Maggie, we can move on to a different topic.
Well, so one thing, just a reminder, maybe you were going to speak to this, but if we manage your assets, you do not have to upload your fidelity statements. So anything at Fidelity we have.
That's right.
And for some of you, of course, we do some tax planning throughout the year, and we've been in communication on estimated taxes, etc. It's always good to also, and probably this is in the questionnaire, I'm going to confess to you that I've never actually seen the questionnaire. As the CEO of Chicory Wealth, I get special treatment on the tax side. So I should look at it sometime, but I know, for example, I'm always, putting in my own file, any charitable giving I did, any proof of that, anything, all my estimated that I have paid, making sure, etc., etc. Question from Denise: all Fidelity, even if we still have some unmanaged? Now, if we are not actually managing it, then we don't have access to those tax reports. If it's under our management, we can access that information very quickly and easily. If it is not under our management, we can't. And you need to get it to us, bottom line. Anything that has come up this year that's new in the tax code, Jeff? Anything that's that changed?
There's been a lot of changes to the electric vehicle tax credit, as well as the home energy efficient property tax credit. And we'll take care of that on our side. I would rather have too much information than not enough. So even if you think something might not qualify for a credit, please provide us the details, and we will assess that for you. I'd rather not miss something than miss it.
Yes, right. We don't
But
miss
what you said before, Maggie, was absolutely correct. Any Fidelity account, don't waste your time uploading the 1099-Rs for your retirement distribution, or the consolidated 1099s for your brokerage accounts. Some of them are quite large, 25 plus pages. And if folks have 2 or even 3 brokerage accounts, that can be timely. So don't go through that trouble of scanning or taking pictures of all of them. It's not necessary. And any transaction that we initiated, donor advised fund contributions, all of that, we have that on file. So please don't waste your time. Your time is too valuable to providing information we already have.
One reminder, too, for those of you who are of an age, that is to say over 70 and a half, and maybe designating a portion or all of your required minimum distribution to charities or a charity or charities. It's called a qualified charitable distribution. So Fidelity, our custodian, is going to report all money out of an IRA as a distribution. They are not going to know that you gave $1,000 to a 501c3, to a charity. In 99% of cases, we're collaborating with you on that strategy. But one thing to note is that if you have done that, if you've used that strategy for all or a portion of your required minimum distributions, we do need to know how much of that went to charity. And ideally, I don't know, Jeff, tell me if this is correct. I don't know that we need to know what charity it went to. We simply need to know. So, for example, if your required minimum distribution this year was $30,000 and you gave $25,000 of that away and kept $5,000 for yourself, we need to make sure that you are telling us for sure that that $25,000 went to charity. Again, in many cases, you're collaborating with your advisor. We already have that information. But again, like Jeff says, better for us to have more rather than less, because we don't want you to be paying tax inadvertently on a distribution from your IRA that legitimately went to charity. Does that make sense? Many of you on the call, this is not germane. You're mere youths, and so this is not this is not a process you're using, but something you can look forward to. But for those of you perhaps watching the recording, just a reminder on that. Let's see, any other things? I guess the other thing I would emphasize, right, Jeff, I hear you say this all the time. It's best to be as complete as possible the first time, because the reality is, as tax preparers, if they don't have all of your data, it's very hard for them to like start a return and then stop and then start, and then it's better that, you know, I know Jeff and his team are always looking, do we have everything we need to really go stem to stern on a return? And that just makes it a lot more efficient for us.
Right, right. It's great if clients can shoot us an email when they feel that they've finished uploading everything they have, rather than us make our best estimated guess that they have nothing else to provide. And of course, we go through your prior year tax return with a fine-tooth comb. So if there's something that was not provided or is missing, we will discover it. But it always helps to get just that, you know, quick email from a client saying, hey, everything I have to the best of my knowledge has been uploaded. You're good to go. That way we won't have to start and stop and, you know, ask you for information that you're still intending to provide at a certain point. That's a great point, Maggie. For sure. And then real quick, before we move on from charitable contributions, Mag, I just wanted to point out, for any charitable contributions that are not made to your donor advised fund or not made out of your IRA as a qualified charitable distribution, a QCD, I want to make sure that clients know for cash contributions, all we need is one grand total figure. We don't need the receipts. We don't need the total amount broken out by individual charity. Just one grand total figure will suffice. Certainly, if the IRS ever comes back and says, prove that to me, we'll need the receipts at that point. So we do recommend that you save them in a safe spot, but you don't need to go through the hassle of scanning them or even making a list of your charitable contributions. One grand total figure is all I'll need. For non-cash contributions, the situation's a little bit different. If your total non-cash contributions are more than $500, we need specific information. 4 items. We need who did the contribution go to, so the name of the organization, a description of what was donated, the date it was donated, as well as an approximate fair market value for what was donated. And as best as you can estimate that fair market value, it does not need to be exact, but so that's for non-cash in-kind donations. But for cash donations, super simple, one grand total figure.
Okay. So
Yeah.
non-cash, things like I took XYZ to Goodwill, or I gave my car to WABE, but in that case, they usually give you a receipt and they do the fair market value.
Yes.
I had to give away a
exactly.
car once because it had a leak in it and it became an atrium over the summer. It was completely molded inside. It's like totally, they couldn't even part it out. It was terrible. Anyhow, I digress. Yes, okay, got it. Other things, Jeff, that we need to be mindful of as we come into tax season? Keep going.
Yeah. In terms of making things super simple, if you have your own business or perhaps you have a rental property and you have a lot of expenses, again, we don't need all the receipts. Don't waste your time scanning those and sending those. All we'll need is a list of your rental expenses or a list of your business expenses. And I always recommend keeping just a short, simple Excel with 4 columns: the date you incurred an expense, who the expense was paid to, the amount, and then some sort of category. So if it's for a rental, was it advertising, or was it supplies, or was it repairs? So just a short, simple spreadsheet. You don't need to go through the hassle there. I think that's really important because a lot of times clients are, you know, scanning 50 pages that they don't need to. And it saves you time, it saves us time. That's another thing I think is really helpful to keep in mind.
Yeah, like we know taxes are annoying enough. We want to minimize the annoyance. The happier you are the happier Jeff is, the happier Jeff is, the happier I am. So we want to keep this as easy as we possibly can. We know it's stressful. I got a question in the chat, Jeff. It's my understanding from Linda. It's my understanding that the IRS PIN isn't ready yet for 2023. Is that your understanding as well? Question mark. First of all, what is the IRS PIN? And tell us more, etc.
Definitely. So it's called an IRS Identity Protection PIN. And I actually did a blog post about this a few years back. So definitely go to our website and read that blog post if you haven't. The IRS Identity Protection PIN is great. It's a 6-digit numeric code. You're sent in the mail by the IRS every single year at the top of the year. And I'll need that code to e-file your taxes successfully. The reason it's a great thing is without that code, your tax return cannot be e-filed. So if your identity is stolen and a fraudster goes to file a tax return under your social security number to get a fraudulent refund, they will not be able to because they won't have the PIN to attach to your return. So it's a great way to protect yourself against identity theft, which we all know is always on the rise.
Rampant. Yeah.
So every year in January, you get this new 6-digit PIN that you'll need to file your tax returns. I have seen clients provide me their PIN already because they are getting them in the mail. So it's possible, Linda, I think you asked that question. It's possible your PIN was lost, in which case you can request it online. There is a section of the IRS website where you can validate your identity and get your PIN. You can also give them a call, or possibly the mail's just really delayed, in which case it's still on its way. You might want to wait another week or two just to be sure, but there are ways to retrieve it. But I have seen them already this year.
Okay, so they're coming out. It's just perhaps it hasn't arrived yet. Got it.
Yep.
Sounds good. Okay. So basically, everybody theoretically should perhaps get one just because of the identity theft issues associated, right?
I would
Of course, for
recommend.
those of us who might owe some money, we might just go ahead and let them file. See if they'll pay our tax bill. It's unlikely though.
Yeah, and I have seen this happen where clients' identity, it's very rare, but I have seen it. Someone's identity will be stolen. I'll go to file their actual tax return and it will get rejected by the IRS because another tax return was already filed under their social security number.
Right.
And at that point, it turns into a big headache because we have to paper file your tax return. We have to attach an affidavit to it. It takes a lot of time to straighten out that mess. So if you can get ahead of it at all with the IRS Identity Protection PIN, it's a great idea.
Great. What else, Jeff? Do you have anything about timeline and when things need to be in before we get pressed into possible extension land, things of this nature?
Yes, we do have information submission deadlines that we really like to stick to. So for personal tax returns, we like all of your information by March 1st. And that's for trust tax returns as well, March 1st, because both individual and trust tax returns are due on April 15th. So March 1st gives us a sufficient amount of time. For any business tax returns, those are due on March 15th. So we ask for your information no later than February 15th. And reason being is that tax season is so highly condensed. We have hundreds of tax returns to prepare in that given time, and we want to make sure to afford the returns the time they deserve. So if we receive your information after those dates, March 1st for individuals in trust, February 15th for businesses, we might have to extend them and prepare them shortly after the due date. But it's for us as much as it is for you as clients, because we don't want to rush your tax return. We want to make sure that it's done properly and with the time that it deserves. Yeah.
And inevitably, for those of you with accounts that are non-IRA accounts, so-called non-qualified accounts, there is from time to time, although relatively rarely with the way we run portfolios, but occasionally there will be an adjusted 1099, a change that the custodian issues. That happens a lot more when you are an owner of things like mutual funds or even exchange traded funds. The vast majority of our portfolios, as you know, at least the stock side is all individual stocks. So it's very rare that you have a revision from an individual stock situation. But we do have bond funds. And so occasionally the fund themselves will have made an error in terms of their calculation of, say, interest or dividends. They have to reissue to the custodian, and the custodian has to reissue the 1099. Again, in situations where we are managing your assets, we get notified of that very early and can usually determine Jeff's on that all tax season long. He's all over it. And if it results in something that requires a change of, if it's any order of magnitude, occasionally it's like 5 cents or something, and we're just like, yeah, forget about it. Occasionally it's something larger, but fairly rarely these days. But just FYI, again, if we've got your money, we'll get it. If your money's elsewhere, and particularly if you have mutual funds in the after-tax space, just be aware that you can get revisions. And I think, I don't know, by law, they say the revisions can't come out any later than what, February 20th or March, but they do. They still do. I mean, I've seen these custodial changes. So we just do what we need to do with it, but just heads up for that, for any of you who've not had that experience, that unpleasant experience of a revised 1099. What else, Jeff?
I really think the very last thing that I want to mention, only because it's a question I get quite frequently, is medical expenses. A lot of times, people go through all of their medical expenses from January 1st to December 31st and spend a lot of time. And sometimes it's necessary, but sometimes it's not. So just keep in mind that in order to derive a benefit from your medical expenses paid throughout the year, 2 things have to be true. You have to itemize your deductions. So your itemized deductions have to exceed your standard deduction. And your medical expenses have to exceed 7.5% of your adjusted gross income. So if you are a taxpayer whose adjusted gross income is $100,000, unless you have medical expenses anywhere close to $7,500, it's not worth your time to add those up. So that's just something to keep in mind. And certainly if you're unsure, shoot me an email and say, I think my medical expenses are about this amount. Is it worth it for me to add them up? And I can tell you, are you going to itemize, and are they going to exceed 7.5% of your adjusted gross income? Yeah, another time saver, I guess.
Yeah, and that's an important thing to recognize, that the standard deductions went up significantly a few years ago. Married couple is, how much is 27,000?
$27,700 unless you're over 65. It's a little bit more. Yep.
So that means, you have to have a mortgage interest deduction or charitable deductions or other deductions in excess of that 27,900, or it just, they kind of don't matter. You just get the standard deduction. And again, for those of you over 70.5 who might be using this qualified charitable distribution or deduction, that isn't a charitable deduction. It's just an avoidance of ordinary income tax on the IRA distribution. So that's one of the main reasons for older folks we have in our system of IRAs where they're giving money away. This is why it's so tax efficient to use that IRA, those IRA funds, because you don't have to get above a certain number for it to benefit you, like it is with, traditional charitable deductions.
That's a great point, Maggie. With the QCD there, like you were saying, you don't have to itemize, and then using the QCD, you'll be able to keep your adjusted gross income lower,
Right.
which can result in lower Medicare premiums, or
Right.
perhaps a discount on your property taxes. There's so many benefits of employing that QCD strategy, other than just you don't have to itemize. Yeah.
There's so many moving parts to the tax code. It's kind of crazy. Anything else about this tax year?
Not that I can keep in mind. I guess the very, very, very last thing, I know I keep saying that.
No, that's fine. That's why you're here, Jeff. Go for it.
Make sure that you review your draft return Internally, your tax return goes through a very rigorous process. You know, we prepare your return, we go back to clients and we ask questions. We ask for missing information. Your tax accountant then reviews the return. Your tax return then goes to your financial advisor and they review the return because, of course, they meet with you throughout the year. Perhaps I don't. They know your situation better. And then finally, your tax return goes to you. And it's very important that you review the draft just to make sure everything seems right. And if there's any changes, you know, even if they're trivial, even if it's, oh, actually, I want my refund going to this bank account instead of the bank account you have, let me know before you sign. Because once you sign your e-file forms, your tax return will get filed with the government and changes can't be made at that point unless we amend. So it's very important to just go through it and ask any question. No question is a silly question. It's really not.
Right.
So definitely do that.
Right, great. That's great. Oh, I have to jump over to a 1 p.m. meeting. Thanks as always. Yes, thank you, Elizabeth. Take care. Enjoy. We're not going to talk about this a lot, Jeff, because I know you haven't prepared. Because then you like to prepare, so I'm not gonna ask you to answer a lot of stuff. I am just going to give a nod to the fact that I'm already seeing articles in the media about how so many of the things that our current tax code is set to expire basically am I right, at the end of 24?
End of 25.
End of 25, okay. So plenty of time yet for the legislature to mess with things. So who knows, but I know we'll start, because it's in the media, we will start to get questions about this. There are a number of things that were put in place. For example, the one that caught my attention was the so-called SALT, state and local tax deduction, that was limited. They put a ceiling on it. I can't even remember now what year that tax law change happened. Do you remember, Jeff?
January 1st, 2018. So
It
all
was
of these,
2018.
yeah, are 2018 through 2025.
Okay, and then they revert. So, you know, some people I know, when that went through in 2018, you know, for example, their state and local taxes and their property taxes, those deductions were well above $10,000, but they got hammered because they got limited by that. Theoretically, that's set to change, but yeah, we should probably not even speculate. Who knows where we'll be? God help us by the time we get to the end of 2020. I know many of us on the call are like, do we have to talk about that? No, we're not going to talk about that today. We're going to keep a high heart. We're going to say, you know, it's all going to be fine in the end.
Right.
And
Right.
as
They are set to sunset. So we'll have
Yeah.
to wait and see, like you said,
Right.
Maggie, what additional legislation is passed. It's going to be a high topic, especially this year with the election.
Yeah.
I guarantee that is something that comes up as we get closer to November
Yeah.
in the discussion, because those items are set to sunset and that will greatly affect taxes. Yeah.
Yeah, for sure. For sure. Before we leave taxes, and I do a very brief market sort of recap, any other questions? I want to give people a chance to put any other questions in the chat about taxes. Okay. Any specific questions anybody has for me that they hope I answer today about anything that I can theoretically answer? And of course, you know, I'll try and answer anything. So you could ask me anything, but let's keep it to the market for now, unless you just want me to opine as I want to do. Please feel free to put it in the chat. I'll just say, first of all, thank you, Jeff. Jeff is one of those rare individuals that has both analytic skills and compassion. And let me just say, you don't find those two things well embedded in your typical tax accountant. Okay, I'm sorry. I've worked with a lot of tax accountants. I think it's true. I think Jeff is awesome. Clients, he's really part of the advisory corps. He works with our advisors very, very closely throughout the year for anything related to tax strategy related to your situation. So again, just thank you. Stay on, Jeff, if you will. You can, but because you never know, yes, Jeff is amazing. Yes, let's hear it. So a year ago, at the top of 2023, when I think back, the market in the world was convinced that the recession that had been priced into the market in 2022, you remember 2022, the market was down significantly, that the recession that had been priced in had simply not arrived yet. And it was a matter of time before the recession, hit the economy. And as is typical of markets try to be predictive. What we saw in 2022 was very much a response to rising interest rates. And rising interest rates in and of themselves are not bad. Rising interest rates are a worry for the market because of the kind of situation they wrought in the economy and how difficult it becomes for some businesses and individuals to continue to, certain businesses to make money, especially if they're highly leveraged, yada, 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 yada. Okay. So all of early 2023 was like, okay, well, it didn't happen yet, but it's about to happen. And then it was like, well, no, it is. It's going to happen. And then later on in 2023, it was like, well, yeah, it hasn't happened yet, but really, it's going to happen. So here we are in 2024, and it depends on who you listen to or whose opinion you take to be true, whether or not the recession that has been foretold actually kind of happened in a kind of rolling way, meaning certain sectors declined, but the whole economy didn't decline. And so that recession that had been foretold has actually happened. It was just so mild, we missed it, and because it didn't happen in the whole economy. Or, depending on who you listen to, no, actually, things really are finally slowing down. And we really are going to have a recession. I will remind you again what a recession is. Technically, it's 2 quarters of negative growth. Okay. And the stock market is not the economy. So part of what we saw in the fourth quarter of 2023, the very, very strong rally in the market, particularly in technology, again, but also more broadly, we saw a small caps rally, which is significant because up until that point, to the extent in 2023 there had been gains, most of it had been really a large cap phenomena and very much an AI phenomena, sort of AI enthusiasm among tech stocks, etc. So the market move began to be more broadly participated in at the end of 2023 on the thought that things really were cooling and the Fed was going to begin to they were not just done raising rates. It's pretty clear they're done raising rates. The question is how quickly they will begin to cut rates. So the market has priced in, for the most part, a rate cut beginning in March 2024. Of late, that has begun to be second guessed quite a bit. Why? Because consumer prices continue to remain, they certainly are advancing significantly slower than they were, but they're not deflating by any means. But most importantly, we continue to have an expanding economy, and we continue to have, arguably even more than full employment. Employment is still extremely strong, and real incomes, meaning incomes have advanced more than inflation. So people really are finally feeling over the last year or so an actual raise in terms of buying power. And it's very hard to have a recession when you've got that. And if we don't get a recession or a slowdown, it's very hard for the Fed to cut rates. So what you're seeing in the market in the last couple of weeks or so is a bit of a stall. And I would expect to see that stall for a while, meaning the market ran up quite a bit and arguably got a little out over its skis in terms of anticipating interest rate cuts. I don't know that those interest rate cuts are going to come as quickly as March. They may not come till June. There's a possibility they don't come at all. I would hold out the possibility that they do not come at all in 2024. The irony, of course, is that we probably have one of the strongest economies we have had in decades. I don't think that's an exaggeration. But if you talk to anybody or if you listen to the pollsters, nobody's happy, which is an interesting phenomena. I don't quite know exactly what to make of it. I'm not sure what to make of it. But by most measures, we've got very strong employment, real wage growth, certainly a slowdown in terms of how prices have gone up. And yet there is a kind of like malaise, if you will, in terms of sentiment, consumer sentiment. So I'm puzzled by that. If anybody has a theory as to why that is, I'm all ears. But I mean, that maybe it's just that we live in a culture of perception, and maybe we just live in a culture of such negativity that it's hard. Or maybe individuals really are suffering in ways that I'm, because I live in a bubble of my own choosing, like all of us have a certain bubble. Maybe I'm just missing the boat on this, but there does seem to be this disconnect in terms of perception. As for stock prices, etc., 2023 was a great year. A lot of market participants, big traders, missed it. They were really very gloom and doom, and they sort of stood on the sidelines. Things went up quite a bit. It was a really good example of why staying invested actually matters, despite all of the voices that say the sky is falling. A really good example of why we try not to think in market, not in quarterly terms about markets, and not even really annual terms. We tend to try and look at 3 and 5 year time frames when we show you your portfolio in terms of how things are going. Everyone on this call and the way we manage money is we're long-term, investors. We're not traders. And the number one thing that matters to us is how you personally are doing in your personal life and keeping you in money until you die. Period. That's what matters. That's the job, So, I mean, from an anticipation standpoint, I think the next 6 months are going to be, could be a bit of a slog. There are some things that could happen that could take the shine off of the gains we've seen, including the fact that Main Street good news, at least Main Street good news statistically, is not necessarily good news for markets. Market wants a rate cut. They love a rate cut. Certainly the things that are going on in terms of the disruption of shipping internationally is not great. The good news about that is demand for durable goods is not as strong as it was. So hopefully that will not lead to a kind of inflationary spiral we saw during COVID, but it's certainly something to keep an eye on. So that's a possible headwind. The political situation internationally is very difficult. Our political situation, of course, here is very difficult. I will remind you, however, that in general, markets don't give a damn about democracy. They don't give a damn, in the short term at least. They don't give a damn about geopolitics unless it impacts the price of oil, and then they give a big damn. So, unfortunately, I like to say that, traders are not, their ways are not our ways, saith Maggie. They are very, very, very different. And so, if your own concerns begin, or anxieties about 2024 begin to heighten because of the geopolitical situation, I don't disagree with them, and I share your anxieties. I do not necessarily think in the short term it equates, however, to market issues. So I'll just get out in front of that and say that out loud. Kind of would be nice if it did, but I don't think it does. So, from our position, from our perspective, we've continued on the biggest challenge for us isn't where to put money from the standpoint of high quality companies. We feel like we've got a good beat on that, and we've continued to do that. The question is always what to do with the bond portion of the portfolio, because that's been the hardest thing to navigate really for the last 18 years. And right now, you can sit in short-term government bonds and collect 4 and 5%. And that's pretty much what we've been doing. We're not very interested in going too far out on duration, meaning longer term bonds, because those yields are, we still have an inverted yield curve. You're making more money on the short end than you are on the longer end of the curve. And the reason you'd go out longer on the curve is that you're betting that the Fed does drop rates, and then you get a capital gain there. And that's not a bet we're really very interested in taking. We're just not wanting to play chicken with the Fed, because this is still a very strong economy. So we're kind of just sitting back and taking the easy money on the short end of the curve and letting it be, and we'll continue to keep an eye on that. But our general position is, what it always has been. You invest in high quality companies that you understand, that have excellent environmental, social, and governance metrics, that have very good, some of which are actually supporting sustainable development goals, not just not doing bad things. Some of them are actually doing good things. And you take the long view, and that's what we have been doing, and it has served us well, and it has served you well, and we'll continue to do that. Trump's negativity about everything except himself affects economic feeling. That was a direct message. I'm not sure if that person wanted me to announce that, but I do think there does seem to be this struggle for a view that wants to look to the future and solve problems and try and be optimistic, and a view that wants to pull us down into the past in a way. And it's very unfortunate that negative view is getting any traction at all, but it appears to be. What can we say? So that's about all I've got on the market side. Unless someone has a specific question for me, I'm very happy to answer it. Feel free to throw it in the chat, because I love to answer those questions. I always enjoy it. And some of you just popped on. Nice to see you, Roger. You missed most of the party, but don't worry, we recorded it and you can watch it later. So, questions, comments? Stump the advisor? Yes, no? All right. Let's see. Liz, remind me, next month, tell me, we have another person on next month, do we not?
Josh Hilley.
Josh Hilley from I'll give you a little preview. Some of you might be interested. So Josh Hilley runs an organization called Citizen Mint, which is kind of an interesting name. We have to ask him where that comes from. Citizen Mint, let me back up and say, the vast majority of the money we manage for our clients is in publicly traded stocks and bonds, meaning, it's highly liquid. We're buying shares of XYZ stock, XYZ bond, whatever. There is a whole universe of money that is invested in things that are not publicly traded. Direct investments, AKA alternative investments. Things that invest in things like building out infrastructure for the decarbonization, for example, or investing on the more risky end, investing in what are called venture capital funds, where you're investing, where money is going to brand new companies that are not proven, and you're trying to get in on the grand floor. There's a whole range of things out there, the so-called non-publicly traded stuff. Non-publicly traded assets have become, I'll come back to that question, Candy, in just a second. Non-publicly traded investments have become extremely popular. There's a lot of money invested in that side. The challenge for the average investor is that most of the folks investing in non-publicly traded types of investments, the minimum to invest in any type of thing could be $250,000 or $500,000 or $1 million or $5 million. It's the purview of, it has been historically the purview of institutions like pension funds or huge endowments, right? Harvard, Yale, etc., or ultra high net worth folks. The average investor has a very difficult time participating in those types of investments. And so it's been a very challenging, and there are a number of them that are very values aligned with what we try and do at Chicory Wealth, very, very impact oriented. So not just trying to be good, solid investments with a good, solid return, but actually try to move the meter on for some social good. A lot of them related to more solar and wind, etc. A lot of them related to energy oriented things. Citizen Mint is almost, I think, the first of its kind, the first platform to figure out how to bring some of these alternative investments to smaller investors with a minimum of, say, only $35,000. So their current offering, for example, they have an infrastructure fund in which I personally am invested, in full disclosure, that has a minimum of $35,000. They will be bringing on more investments to their platform as time goes on. And because we want to educate folks about what's possible and what's available, and by the way, it's not, if you invest in something like this, it's still like under our management, it's the same terms. It's not a sale, it's not a sold product. It's just an alternative way of investing. But we decided to bring Josh on just to hear him talk about what they're doing and what they hope to build out. And I'm excited for it because I do think there's a lot of value there and a lot of interesting things for those clients who can stand the illiquidity. The number one thing about a non-publicly traded investment is that you can't just turn around and sell it tomorrow. If you have shares in Apple today and you want to get liquid tomorrow, we can just sell them and bang, you got the money. And alternative investment like this, even at a relatively small dollar amount, is typically going to get tied up for 5 to 7 years. So you've got issues related to liquidity. The number one issue, though, historically has been the amount of money you'd have to get into one of these things. So the fact that the minimums have come down, it makes it a little bit more scalable for smaller investors. And we can now put some of these things inside of IRAs too, without it being a big hassle. So there's some new things opening up. So we want to just educate you and anybody who wants to join about that universe and what's happening in case any of you are interested in it. Your advisor would be the one to judge, along with you, whether or not it's appropriate for you. It won't be appropriate for everyone because of the liquidity and the risk, etc. But it's an interesting thing. So Josh will be on. And then in March, one last preview.
So let me say about March, 2 things. One is we're going to have a big announcement of a new initiative that's all I'm going to say about it right now. But you definitely should mark your calendar because it's going to be on a different date. Usually these webinars are held the 3rd Tuesday of the month, but Maggie has something on that date. So it's going to be on Tuesday, March 12th.
We're moving it up.
Tuesday, March 12th. It'll be up a week earlier. So you might want to mark your calendar, and I'll be sending out more about that later.
Thank you, Liz. And I'll answer this last question here. Feeling on Bitcoin. How does Bitcoin make me feel? So confused. Some of you who follow, maybe some of you follow the financial news, know that, first of all, I know you've heard of Bitcoin, etc. Bitcoin is one of the few cryptocurrencies that made it through the so-called crypto winter without going to zero, because there's arguably a there with Bitcoin in a way that some of these other things there was not. But what's unique and interesting about Bitcoin and what's happened here is only just last week, the SEC finally approved a series of products that are now exchange-traded funds that are tied to the spot price of Bitcoin. So up until now, to invest in Bitcoin, you either had to go to a platform like Coinbase or somewhere where it was held. Or if you were with Fidelity, Fidelity had an offering called the Wise Origin Fund. It had a $50,000 minimum. You could invest through their Wise Origin and actually own Bitcoin. You can now actually own Bitcoin in a traded, exchange traded fund. So what will that mean? I don't know. I don't know what that will mean. I will say that I think there were something like 4 or 5 different sponsors of exchange traded funds, including Fidelity. Fidelity, I believe, has its own offering. Fidelity notably has been a miner of Bitcoin, meaning they have been doing the math to be part of the Bitcoin chain since like 2014. So they were extremely early adopters on this Bitcoin. They own, they mine, they offered a product. Now they have an ETF. It's a very volatile asset. Some people don't even think it's an asset. Some people don't know what it is. Some people think they know exactly what it is and that it's going to change everything. All I can say about it is my own position is it's interesting in that it is not going away. It's been around a long time. What it actually is and what it will be is an open question. I do not think investing it in it is for anyone who doesn't have an extremely high risk tolerance and some combination of curiosity and probably masochism if you really watch the moves. So I am invested in Bitcoin, full disclosure. I like to tell you when I deviate from our standard model. I have a position, it's not a huge position. I bought it mostly because I'm curious. I am both curious and arguably slightly masochistic. And I'm continuing to watch it. So where it ends up, we may not know in our lifetime, some of us on this call. Some of you will know if you live a natural life, like our friend Jeff there. High probability Jeff knows. Me, maybe not so much. I don't know. But so that's how I feel about Bitcoin. That's all I can say. I do think the advent of the ETF is going to be interesting. That could mean the price goes up for a while because more individuals jump in. It could mean the volatility gets that much more because jumping in and jumping out becomes that much easier. I don't know. We'll see. We're going to watch it. I will also say the people who created these exchange traded funds, like Fidelity, like, trying to think. Maybe iShares has one. I think it's a race to the bottom in terms of the pricing. In some cases, you can invest in that ETF for 0 cost for the first 6 months. They are all just trying to suddenly control the market. So all of those people think, all of those institutions think there's a there there. That doesn't mean they're right. Lots of times institutions think there's a there there and there isn't. So that, it wouldn't be the first time they were wrong. But there's a huge like market share grab going on. So that's something I'm just curious about. I'm kind of watching. So we'll see. And yes, for those of you who might own Wise Origin on the call, yes, I've already sent the email to Fidelity and say, hey, when are you transitioning this to the ETF? Because there's basically, it's like 75% less in terms of the internal cost. I am waiting for a reply to my email. As soon as I know, you will know. So that's where we're at. Great question, thanks. That gave me a chance to go off on a little tangent. Other questions for Maggie today before we sign off? All right, I guess not. All right, well, thank you all for joining. It's a pleasure to be with you like it always is. Happy 2024. Keep a high heart. Do not give in to despair. Work hard, put your money where your mouth is, get people out to vote. And thank you, Jeff, very much for your time. And thank you, Liz, for your keeping us all organized and ready to roll. All right. Enjoy the rest of your day. Take care.